My name is Michael Guyett, publisher of the Lead Lag Report Group. Joining me for the hour is Dan Arbess, who has a storied career in markets and knows a lot about geopolitics. Dan, for those who are not familiar with you, introduce yourself. Who are you? How'd you get involved, interested in markets, and what are you doing today?
Well, today, Mike, I'm talking to you guys, and I'm very happy to participate with the group of people that are on this call. I don't know how to introduce myself other than to say I'm an inductive thinker who has spent many years observing facts and trying to connect the dots to what I think should be constructive outcomes. I have been a lawyer. I advised governments in emerging markets in Eastern Europe and elsewhere on economic reform and restructuring and privatization. I've been an investor in post-privatization private equity in Eastern Europe and Russia, and most recently built and managed the $3.5 billion Xerion hedge funds, which were multi-asset class, top-down, thematically driven by geopolitics and geoeconomic analysis, and bottom-up security selection, first in distressed credit, and then as the world turned in housing short securities, CDS protection on mortgage ABS CDOs and short of home builders and banks and the like, and then eventually in long credit equities and everything else following the monetary policy impulse at the end of 2008 and forward. I closed the hedge fund 2014 to become more directly involved in, as a principal, in trying to solve problems. Have been primarily involved in neurobiology for the past several years, but that's outside the scope of markets. Still staying in markets, managing the so-called family office assets primarily.
All right. So first, that term "top down" is thrown around a lot on Twitter. I obviously know what it means, but define what top down actually means in practice, because I don't know if people really can distinguish between top down and macro and some of the nuances.
Well, it's actually a relatively recent phenomenon to be thinking about top down separately, I think, from bottom up. It's a feature of geopolitical and geoeconomic instability that most of the current generation of investors have been living through, dating back really 15 or 17 years to the global financial crisis. It used to be that you had normal business cycles. You would have periodic recessions, periodic cycles of credit defaults, and the economic backdrop would be relatively stable and consistent. The financial crisis of '08, I think, ushered in a period of geoeconomic instability that has really continued, even though excessive government involvement in the markets has tried to modulate the effect of the instability. I think that we are about to pay the price for government's over involvement in markets to try to stabilize both markets and the economy.
Okay, so that's an interesting way to think through things. The argument that in the Federal Reserve's desire to create stability post GFC, it actually created instability on the political front among different countries, if I'm hearing you correctly.
Well, that's partly correct, but I think it's really a matter of the failure of our political system to respond to the crisis with responsible fiscal policy back at the end of 2009. In other words, the Fed and monetary policy impulse came in to try to stabilize the disorder of the financial crisis by reducing interest rates and then moving into quantitative easing, which is buying bonds to try to stabilize credit markets, which was initially successful, But I, for one, thought that was pretty much the end of the effective role of monetary policy after about a year of QE. I got that wrong by 10 years, where QE continued and then went over the line, because QE, as I had been saying back as early as 2010, I think met the limits of its capability pretty quickly, because it did not do much to stabilize the economy. It did help to stabilize financial assets. And the reason why it didn't translate into assisting the economic recovery is because the banks that bought treasuries, and the treasuries that were then sold back to the central bank, proceeds went back to the banks, but the demand for credit in the market for lending was very limited. So the banks, instead of lending the proceeds, ended up buying securities, which was good for investors in the securities markets, mostly wealthy people, but didn't do much for the economy or for anybody else. Now, when we got to the pandemic, we crossed the line into what's called modern monetary policy, or what I mockingly called helicopter money in a Wall Street Journal op-ed that I wrote in 2013, which made the case that the limits of monetary policy had already been reached and surpassed. And the next thing that would happen with monetary policy, if we didn't get fiscal policy action from the Congress to improve the economic environment, was going to be helicopter money, printing money and sending checks directly to people. That's exactly what ended up happening in the pandemic, which caused the current round of instability, because by injecting cash directly into the economy, of course, we stimulated consumption, but that consumption was artificial and led to the round of inflation, which has been compounded by the Ukraine war, by other geopolitical, what I think have been poor geopolitical foreign policies by the United States and the Western allies, to the point where we now have sort of sustained inflation, excess liquidity in the markets, which needs to be drained. And when it is drained, it's not going to look pretty for financial assets.
By the way, so I'm actually glad we're going in this direction, because I'm with you. QE2 twist and then ultimately QE3 were not only not needed, but QE3 in particular, I would argue, is where a lot of the distortions in market dynamics and incentives really started to take hold. And I say that because I've been obsessed with this myself the last several weeks. If you were to plot the monthly returns of the S&P 500 against emerging markets, against international stocks, there's a clear dynamic where after QE3, September 2012, US markets basically exhibited like a normal distribution pattern, meaning left tail, right tail looked the same, which is not the way markets are supposed to work. You're supposed to have higher risk of downside. The effect of QE3 was it distorted asset markets such that every other part of the globe had left tail risk except US S&P. A lot of momentum then from international players goes into US stocks because of the unfair advantage of QE. Now you remove QE, and now you're in an era where volatility likely is going to be higher on average than what anybody has been used to, taking out COVID to begin with, right? Because you're not going to go back to QE, I don't think, at least anytime soon. As you look back on the second round of quantitative easing twist and then ultimately QE3, why did the Fed keep going? I mean, it's not like we were in a crisis. We were past the GFC.
I think the Fed kept going because the Fed interpreted a third arm to its own mandate, which had heretofore been price stability and employment, full employment. The Fed decided that financial stability was a part of their mandate, and they translated that into basically ensuring that markets went up. And I remember Bernanke had a term for that, which was the so-called wealth effect. That if you drove stock prices higher by keeping interest rates lower by buying more bonds on the Fed's balance sheet, then liquidity would move into the equity markets, and the wealthy would consume more. There was a real limit to that logic, because there's only so much consumption that the top 1% of the population can engage in. And of course, it's been great for high end retailers and luxury purveyors, but it really had, that did not trickle down in any significant way to the rest of the economy, to the other 99% of the economy. So the inequality of outcomes, which is not something that I think is a matter for government to regulate, but the inequality of outcomes has really worsened over the past 10 or 15 years. The middle class has really suffered from this phenomenon because they have not been in the financial markets. They have not enjoyed the benefit. All of that now, I think, is about to reverse, provided the Fed follows through with the policies that it needs to. And this is where I think, Mike, it gets really interesting because the Fed has issued so many short term treasuries that need to be termed out over the horizon. The interest rate curve, from the overnight rate or the twos to the 10 years, when the majority of 1 year treasuries need to be refinanced out at the curve. Today the curve is inverted
Right. And
because
sorry, you
go
were
ahead.
continue. Sorry.
No, go ahead. My phone was ringing. I got
Yeah, no. Well, I was going to expand on that point about the wealth inequality and the gap that widened with every single round of QE, and then obviously any kind of fiscal stimulus after that. It's not just a widening gap within the U.S. borders, right? It's also U.S. against everything else.
no, Mike, I lost you there for a second because my phone was ringing. I've got it on DND now. I apologize.
Yeah, no worries. What I was saying is that it's more than just the idea that QE2, twist three, all these stimulus measures widen the wealth gap. You can argue unnecessarily because we never needed the extra stimulus. It's also that widen the wealth gap within the U.S. It also widen the differential between the U.S. and everybody else, given that the S&P, for example, was the only game in town.
Well, yes, I think that's the case. There are other structural problems why the U.S. has done better, and I think the U.S. will probably continue to do better just because of the nature of our economy and because of the fact that we've exported what are truly irresponsible fiscal policies everywhere else in the world and monetary policies. We're still the cleanest dirty shirt as a currency in the G7, but what we here in the United States are missing is that as a consequence of our truly poor policies toward China and elsewhere, we are in a re regionalization of the global economy right now, where a much larger portion of global commerce than we really appreciate is being conducted in other currencies, specifically in the yuan, where while we were playing the trade war in the Trump administration, which has only been doubled down on by the Biden administration, while we were fighting over a trade war which was really not legitimate on the numbers to begin with, China was really enjoying themselves under the Trump administration because they were very quietly externalizing their own currency, locking up through the Belt and Road Initiative all of the raw materials they need from Russia, Saudi Arabia, Latin America, and Africa, and paying for it all in yuan. So they now are in a position where they have a vertically integrated consumer economy with all the raw materials acquired and leveraged, and they're in a position now, which they were not in 5 or 7 years ago, to lock the United States out of exporting into their market just at the moment that automation, which is causing labor supply de-employment in China as it is for us here, is equalizing manufacturing competitiveness, where the United States can manufacture product landed in China competitively with China itself. That's a gigantic miss. I remember when I was a kid, the dream was always, could you imagine one day we could sell stuff from North America to the Chinese consumer? There's a billion Chinese, and one day when they're rich, okay, now there's 1.5 billion Chinese, there's 300 million middle class millennial Chinese that have the money to buy stuff. And we, as a result of our lousy policy, are going to be locked out of that market.
The automation point is an interesting one to tease out a little bit more in the context of the short-term dynamics around a strong labor force and the kind of call to the idea that labor is going to be tight for a while, and this is what the Fed has to keep on fighting against. I thought automation was the way to resolve all these kind of upward wage pressures.
I think it is the question, and I find it a little bit difficult to digest myself. The employment numbers. There's a lot of shenanigans about how these numbers are reported. Right now, we supposedly have a very strong labor market, but if you look at the participation rate, it's still extremely low. Like, I mean, as low as it's been in the last almost 50 years. So you have a lot of people who have just withdrawn from the labor force, either because they've aged, they don't feel like working because they've been getting checks from the government and they've gotten used to the idea of getting free stuff for the younger cohort, or at the other end, because they're just withdrawing from the workforce, but they're technically qualified to work, age wise, they're just not working. They're not participating in the job market. If you include the people who have, voluntarily withdrawn from the job market, I would say the employment picture is going to look a lot worse, and it's probably getting worse as you see more and more technology displacing more and more tasks. Like if you go on ChatGPT, you can ask for a draft legal agreement on whatever you want now. You don't have to hire a lawyer to do a non-compete or confidentiality agreement to start a deal discussion, for example, or anything else. So my point is, more and more white collar workers are in fact being displaced by technology. I don't get why the employment numbers look so good. The unemployment numbers were, 50-year low in unemployment. Yeah, fine, but include all eligible employees from, the ages of 20x to 59, and now you got a different situation. I just think we're getting fed all kinds of stuff, and we're living in a world where it's very hard to ascertain what the reality is. But it does not make sense to me that interest rates could continue to be rising. We're now at 4.6% on the overnight rate. I think that we're going to 5 or 6%, and I've been saying that for a year since people thought I was crazy. And the 10-year is 100 basis points lower than the overnight rate. That curve inversion is not sustainable. And I think the reason why we're experiencing it is because the marginal analyst on the marginal buy side desk was probably in high school the last time the 10-year Treasury rate was 4.5%, which is, in fact, the historical average since the Volcker era in the 1970s. I think the 10-year bond in the next year or so is probably going to see 5, maybe 6%. And when you consider the impact that that's going to have on spreads too, you're going to see rates higher for much longer than anybody anticipates. I'm not the only one making that call now, but when I started to make that call a year ago, I certainly was.
But you're hitting on something which has been a theme of mine. Despite this melt up, which by the way, folks, I still think we're in. I have my reasons. I'll outline them. But I think with hindsight, we're probably going to look at last year and this year as two back-to-back bad bond years. And you've been at this much longer than I have. A lot of people, including myself, started the year saying, you know what? Now there's yield for bonds. Now it gets to be interesting. But if you start peeling it back a little bit, last year was the year of a duration crisis. You have a lot of loans that are on the corporate side are rolling over next year because they took advantage of cheap COVID financing rates with maturities of 3-4 years. So you're going to have conceivably this debt tsunami of rollovers into higher rates by a lot of zombie companies. Um, if that creates a credit event, it wouldn't happen in 2024. It would probably happen in 2023 as the stock market sees that. So to your point about spreads, I'm with you. I think there is a real risk that, especially the kind of highly leveraged junk debt issues could really get blown out.
Yeah. I mean, okay, if we want to talk about the outlook for credit markets, there are a lot of interesting aspects of this. The credit markets, even the leverage credit markets, which is the lower quality issuers, the dynamics of that market have changed very significantly in the last 5 to 10 years. More of the market is in leverage loans, And half of the leveraged loan market is private lenders. And the business model of the private lenders was to collaborate with private equity sponsors in taking companies private on a leverage basis. Those lenders are going to find it, I think, themselves to fight with their equity partners. I think there's so much liquidity, so much dry powder around. They're going to continue to layer in more and more debt to prolong the equity optionality of their equity sponsors. So they're going to they're going to layer in on their own facilities more facilities to provide liquidity to them and hope that things improve. So we're not going to see the same types of, okay, we're going to hit the wall in the loan market and then we're going to have a lot of workouts. A lot of the capital structures are purely private, two-party owners, one private lending entities and the other private equity firms. For the others, we have to consider the so-called broadly syndicated loans and high yield bond market. We have to consider the characteristics of the issuers, the borrowers. Many of them are asset light cloud technology companies. Those businesses don't require a lot of capital and generate very high profit margins. I've never been of the view that sort of so-called tech should be all lumped together and, well, tech is going to suffer when interest rates go higher. If you don't need to borrow money because you're generating a lot of cash, it doesn't seem to me that you as a company are going to be directly impacted, except to the extent that your clients are not buying what you're selling. And I still believe that most large companies are going to be adopting the technologies that are offered by these asset like companies. Then there's another category of companies, which are the old industry capital intensive companies that have been floating on one times debt service coverage ratios for sort of the last 20 years, since the 2005 time where there should have been a new distressed credit cycle after the previous one worked itself out. That cycle was deferred by securitization, distributing low quality risk around the global system. And then we had the '08 cycle deferral with zero interest rates, which allowed these, what you referred to before, Mike, as zombie companies to roll forward their debt with zero interest rates and term them out for another 10 years. And then by the time we got, 10 further years down, we were in the pandemic. So a lot of issuers took the opportunity to roll forward for another 10 years in the 2018, 19, 20 timeframe. And so I think you're going to see more and more problems coming from those who didn't, and more problems in the broadly syndicated loan market where you have lower quality borrowers, but it may not be as broad based a corporate credit cycle as some people think.
How do you think about the sovereign credit cycle? And I say that because the big concern last year, up until the dollar started reversing, was the dollar's going to get to a point where you're going to have some kind of default. There's going to be some kind of foreign funding issue coming from either some corporation or sovereign entity, government-wise. Um, it's interesting, even just as we're talking, to see the dynamic seemingly reassert where long yields are rising in the US while the dollar is itself rising, which again is unusual except for last year. How do you think about the dynamic of kind of a global credit cycle maybe causing a crunch at some point?
Well, I think, as always, the core location where there is risk is probably the United States, and so we have a situation now where outstanding sovereign debt is $31 trillion. It's coming up on 125% of GDP, which I don't think is a particularly important metric. But what is an important metric is the debt service on the outstanding debt. We are going to be spending over $1 trillion very soon servicing the national debt. That will be the number one budgetary item, expenditure of the government, ahead of healthcare, ahead of Social Security, ahead of infrastructure investment, and certainly ahead of all other non-discretionary, rather all other discretionary expenditures. I think that if we owed a lot of debt to other nations, the United States would be in big trouble. I've gone back and looked at what the experience of Weimar Germany was. Weimar Germany had a real problem because their debt was denominated, in foreign currency, and most, emerging market debt is denominated in U.S. dollars. We're still the reserve currency, but what I'm concerned about, Michael, is the credibility of the United States as the reserve currency in an environment of the type that we've been describing, with more and more transactions going on in other currencies, specifically in the yuan. That's undermining the petrodollar regime. The Saudis no longer need to sell us oil and buy our treasuries. They don't need our treasuries. They don't need to sell us oil because we're independent on oil for ourselves, and they're buying oil from China. I'm not suggesting that China is going to become the reserve currency, but it may be that there is no longer a reserve currency. Now, the big thing that I'm focused on relative to US sovereign credit situation, first and foremost, is the looming supply and demand of treasuries. There's $5 trillion of treasuries that are coming due in the next few years. And the Fed's balance sheet started at 9 trillion. They were going to do aggressive QE. Today stands at 8.5 trillion. And when you think about it, if the Fed is not going to continue to buy its own bonds, okay, and incidentally, we're incurring $1 trillion of incremental deficits every year, okay, if the Fed's not going to continue to finance those itself, then it's gonna be over to the private markets to come in. Foreign buyers that used to own 35% of the treasury market are reducing aggressively. Okay, the largest foreign buyers were China, Japan, Saudi Arabia, all reducing treasury holdings. So you've got fewer buyers, way more supply. And by the way, the structure of the treasury auction market is changing. It used to be that the dealers were the primary buyers in treasury market auctions. Today, you're seeing more and more private funds come into the treasury market. And what those private funds are ultimately going to do is they're going to say, wait a second, 3.5% is way inadequate for the risks that we're taking here on US credit. We want to be paid a lot more, and it's already starting to happen. I mean, if you look at where recent treasury auctions have been going, yeah, the spread is more or less still 100 basis points of inversion on the 10-year. But slowly but surely, the 10-year is creeping up because the auctions are filling in, looking for a higher return on their treasury investments. And that's kind of what I'm worried about, is at some point there could be a change in perception that could cause the 10-year to blow out. And as the 10-year blows out, the cost of debt servicing this gigantic debt burden on the United States is going to rise and spiral to the point where I think it's going to be unsustainable. So, yes, I'm absolutely worried about the sovereign, but I'm most worried about the U.S. sovereign. And again, I want to repeat again, I think the United States will continue to be the leading economy for all the reasons that we're familiar with: rule of law, innovation, all of the great things about this country. But I do think that we have a serious credibility problem now that will sooner or later, and I think it may be sooner, translate to much higher rates. That will not be a good thing for the economy as a whole, for duration assets, or anything else. So, where I'm staying right now in credit if I'm long at all, is it in the overnight rate or in the very short duration credit? Because as you asked the question at the beginning of this part of the discussion, I do think that long duration assets are gonna be hit as rates go higher.
Let me reset the room for the remaining 27 minutes here. Everybody, please make sure you follow Dan Arbess. I've known Dan for a long time, and he's always an incredible thinker when it comes to markets, macro, and has some really great ways of communicating. For the audience, Dan, you often hear that, as you alluded to, that point of credibility, loss of the reserve currency status. Walk through to the audience. What does that mean in practice? So there's that idea that's been floating around for a while that at some point we're going to have a basket of currencies. You're not going to have a single reserve currency. It's going to be a diversified basket. Maybe gold's a part of that. Maybe Bitcoin. What are the implications on how the U.S. government runs if that's the case?
Well, for the U.S. government to run, it's got to be able to finance its debt. Okay, and it's got this $31 trillion of debt that's increasing by an additional trillion last year and another trillion this year. And, what we've got is a situation where there's been no fiscal discipline. It used to be, I'm looking at the people on this call, a lot of people on this call will remember the days when Paul Ryan was talking back in 2011 about the United States being insolvent and the need for fiscal discipline. Paul Ryan is no longer in public life. There's some interesting informational content in that. My concern is that there's no discipline in Congress. It used to be that the Republicans called Democrats tax and spend. And it turns out that the Republican Party is just no tax and spend, even worse than the Democratic Party.
I love you making that point, by the way, because it kills me. Both parties suck. They both are terrible. No matter what you do, the debt keeps on going higher.
Well, that's right. And you heard the president's State of the Union address the other night. It was full of unreality. I mean, we can talk about what's going on in foreign policy also, but in this respect, it's kind of like, well, whatever it is, we're just going to do it. We'll just spend it and it's not a problem. We'll just borrow the money. Well, what I'm suggesting is at some point, people will look at the balance sheet of the Fed and at the credibility of the repayment obligation and say, well, hold on a second. All you're doing is adding debt to finance your spending and then adding more debt to pay the interest on that debt. That doesn't work ultimately. And to me, it's only a matter of perception. If people actually internalize what I'm suggesting, the bids for treasuries, for the risk will reprice to a much higher level, and that will be a very, very poor thing for the economy.
Now, I've often heard from students of history this idea that when you're in this kind of a debt setup with any country, the historical way of solving it is war. Not to sound overly dramatic, but there are some arguments for that.
War or devaluation of your
right.
of your
Right,
currency,
exactly.
right? Which is so called inflating the debt away. But none of those options look particularly good. What I'm saying is that the concept of fiscal discipline has been completely lost on our government. And there've got to be some consequences for that. So far, they've escaped scot-free. Like, I've had conversations with senators and members of Congress where even 4 or 5 years ago, as long ago as that, where I've talked about this, and they've said, it's not a problem. We just print more money and just print more money to pay the interest on it. Well, you can't, because at some point people are going to say, well, hold on. And I'm not saying this is dramatic, but there are countries that are operating outside of the dollar system now, specifically the countries that I referred to that are dealing increasingly with China in China's own currency. And now, again, I'm not saying China is going to take over the world. They got big problems with their economy. If you ask me whether I want to change place and move to China, the answer is, of course, not. But just because we live in what we think for good reasons, is the greatest country on the planet doesn't mean that we're perfect and we don't have to address our problems if we want to sustain our status in the world.
Oftentimes, when I open up Twitter and I look at what's trending, it seems like almost every other week now I see World War III trending. Um, I don't know if it's just a function of fear mongering or whatever it would be, or the algorithm. Do you get a sense, just when you look at the globe, that we're in kind of a high risk cycle, meaning a period where you're going to see more dynamics like Russia going to Ukraine seemingly coming out of nowhere, and becomes another disruptor for the globe? Or is this just sort of another sort of run of the mill cycle in human history where it's not anything to worry about too much? I mean, obviously the loss of life is horrible, but just in terms of one's day to day lives, I guess.
Okay, Mike, you're so smart. You open up such profound questions. So I apologize because I really want. I hope that we're having the benefit of everybody else's sort of listeners' questions. But on this one, there is a very big answer. Okay, which is if you look back over the scope of history since the end of communism in the Soviet Union in 19 really with the fall of the Berlin Wall in 1989. I was intimately involved in that period of history in Eastern Europe and the Soviet Union. There was a moment in time under Bush 41 where people like Francis Fukuyama, who's a good thinker, were saying, okay, this is the end of history. Market democracies have prevailed and these other systems are finished. And the United States, in fact, had a moment of hegemony during the Clinton administration and beyond, but we completely blew that status. And we're making the same mistakes now with higher consequence. What do I mean by that? The first thing that the United States did was they expanded NATO, which was a military alliance that was designed to counter an expansionist ideology of the Soviet Union that no longer existed after the Soviet Union, fell apart and became the Commonwealth of Independent States. And I'm not saying that we had any intention in the West of expanding NATO, and I even understand how in our gratitude for the failing of the Warsaw Pact, we could have cultivated countries like the Czech Republic, Hungary, Poland, and the like to join NATO. What we, as the leaders of the free world at that moment of time, should have done was reposition NATO for a post Soviet world as something more than a military alliance. And so the consequence of failing to reform NATO, but only expanding it, was to basically give this guy Putin, who incidentally started out as a technocratic reformer. He was brought into Yeltsin's government by Anatoly Chubais, who was the privatization minister. He was my client when I advised them on the privatization program from 1992 to 1996. Okay, Putin was considered to be a good guy. Okay, until and it was in fact Chubais that got him into Yeltsin's cabinet and designated the successor to Yeltsin. We can talk a lot about Putin, and I've written about Putin and the oligarchs separately. I don't want to get distracted with that now. Only to say that if you look at what we failed to do under the Clinton administration, and then W got tied up after September 11th with the well intended notion of regime change, which we learned it's easy to get rid of the bad guys, but expecting them to be followed by American democracy in places like the Middle East that have no cultural tradition or legal tradition, the rule of law for American democracy, turned out to be just not good. I mean, just naive. And then the Arab Spring under Obama, same problem. And Obama's response, okay, Obama just quit. He just withdrew from the world. So what we got in Trump was, some of Trump's instincts were actually right, but it was fundamentally chaos for our alliances and chaos relative to what should have been the policy toward China. So if you fast forward to where we are with the Biden administration, we are making exactly the same mistake in the Biden administration in China as we made with Russia 35 or 33 years ago. And that is, we are encircling China, thinking that we are deterring them. I saw Jake Sullivan at the Council on Foreign Relations a few weeks ago, just a couple of weeks after I saw Henry Kissinger, who occupied the same position as Sullivan, a national security advisor in the Nixon administration. Kissinger talked about how and why we created the policy of strategic ambiguity around Taiwan. Let the Chinese think it's theirs in 100 years from now, and let us think it's ours right now. Jake Sullivan, when asked about China, his answer was, well, we need to improve our deterrence and we need to move our military into the Taiwan Straits, closer to China, to deter China. If Donald Trump ever said anything intelligent about foreign policy, the thing that he said that I thought was actually brilliant was Taiwan to China is like the eraser on his pencil is to the Resolute desk in the White House. China could move on Taiwan and consolidate Taiwan anytime it wants, and there isn't a thing that we can do about it. So, does anybody really believe that by projecting our military right in China's nose, we're deterring them, or are we inviting them to preempt? Similarly, does anybody really believe, and if they ever did, do they believe it anymore, that by flirting with Ukraine, that would never have been qualified to join NATO? Never. I mean, Zelensky was about to go out the door from corruption. Ukraine was nowhere near ready to join NATO. Why would we talk about bringing Ukraine into NATO? I'm not saying that what Putin has done is any good. Putin is a war criminal who's conducting genocide, that we now have a moral obligation under the genocide treaty and the laws of war not to acquiesce in. So we have no choice but to fight back and to support Ukraine against genocide. That's in the Nuremberg obligations. But why on earth would we invite them effectively, give Putin a domestic narrative to sell his people? The Russian people are legendarily patriotic for the motherland. World War II should have taught us they will take endless misery to protect the motherland. I mean, there are people that live in my neighborhood in New York City who have family in Russia and call their family and say, you got to get out of there. This is terrible. This guy's horrible. And they're like, I don't know what you're talking about. We're protecting the motherland from Western expansionist aggression. Facts are only how we perceive them, and narratives are what we give people to change their perception of the facts. So now you have a guy who's committing genocide, and at the same time, we have the same policy going on toward China. If China moves on Taiwan before we've found another source or built our domestic semiconductor industry, the economic consequences of that will be 1,000 times losing Ukraine.
Yeah, no, that is 100% correct. You use a word which I smiled when you said it, because when you alluded to the naivete with the Iraq War and the Middle East, that was a word my father would use a lot as the ships were getting shown on TV before we went into Iraq, saying that the American politicians they're naive. They don't know how the culture works, and they don't know what they're getting into. I myself keep going back to this point that a lot of the dynamics I think we're suffering through today really started with the Iraq War response, and I say that because aside from the estimates that show that $8 trillion was spent and the lives that were lost needlessly with the war, it also created this cultural shift, I'd argue, in the U.S., where most people don't care about these issues that you and I are talking about. They care about consumerism. They care about buying. I mean, that was one of the things that Bush said many times over. We got this. Don't worry. Go out there and spend. Don't let the terrorists win. Just let the economy keep running. It's kind of abdication of authority to those that ultimately, I think, enabled the MMT mindset that got us to the place that we're at now. Is it really naivete among politicians when it comes to these geopolitical dynamics, or is it sort of willful? Is there a plan? Is there a reason? Do they know that they're doing this so that down the line it ends up being more of an excuse for consolidation of power?
I don't think that W. Bush, for example, did what he did for any secondary reasons. In other words, I don't think he did it for his own political gain or anything like that. The Bush family are multi generational public servants. I may not have agreed with what W. Bush did in all cases, or even in most cases, but he was a legitimate public service, unlike I would say most of the members of Congress who, on the day that they're first elected, the first thing that they do is start calling people for money so they can be reelected again. Okay? That's in the House of Representatives. These people are careerists and they need to have their careers cut off because public service needs to be public service. The President of the United States is the president of the United States, and I have to believe that he's not there for his career, and anyway, he's limited to 2 terms. I truly believe that W. Bush and the neoconservative thinkers that were surrounded by him, or were surrounding him rather, well intended, getting rid of what they thought were the bad guys, the threats to stability and other people's lives. And they truly intended that if we get rid of the bad guys, we'll spread liberty and American democracy to these countries. And I truly believe that they did not fully, and I've talked to a bunch of them directly recently. I don't think that they fully thought through what is involved in trying to build a democracy in a part of the world that does not function like that. I mean, take a look at the Palestinian Authority as a good example. Take a look at, any of these countries in the Middle East. You cannot export American democracy in a country that lacks the cultural tradition and that lacks the legal infrastructure for it. So we have to accept other countries may be governed by other types of government, but that doesn't mean that we have to agree with everything they do to still be able to do business with them. And that, I believe, is what our relationship with China needs to boil down to. Yeah, not cool that the Chinese are treating the Muslims in the West very poorly. We can object all we want, but the United States has been doing business with people that we don't particularly like Pinochet in Chile, for generations now. Let's be practical. We should be doing business with China. We should be we should have, under the Trump administration, gone with our allies instead of antagonizing our allies. We should have chosen our battles and focused on China, lined up with our allies while China was still in the market for things that they needed from the West. And we should have read to China revisions of the World Trade Organization terms that would need to be agreed to in order for them to stay in the WTO, specifically on subsidies and intellectual property protection. Instead, what did we do? We fought with our allies in Europe, and at least Biden has tried to repair that. But where we are right now is our behavior is as bad as theirs. We're subsidizing industries. The Europeans are subsidizing industries. Free trade is going out the window, and that's going to cost everybody. That's going to create disorder and increase the cost of everything to everybody for a long time. So I think inflation, higher interest rates, they're all going to be here. All the nasty things that we've seen in the last couple of years, they're not going to resolve. They're just going to get worse until we actually get back to where we started before Trump came into the picture, and even before probably Obama came into the picture.
Right. So, I mean, it goes to a broader theme of mine. We're in an age of turbulence all over again, and an age of disruption. And maybe just for the last few minutes, Dan, since you mentioned Chat GPT and sort of the rise of the machines and robots taking over, taking over even Google, as now Microsoft is getting into the game and others. I'm just curious. I mean, do you think this, you can allude to, right? It's like you can go on Chat GPT and you can get a contract, a non-disclosure, have it write it out for you. Do you think this is going to be as much of a game changer, as disruptive as the headlines make it out to be? Is it something that people should be concerned about, excited about? It's all new. It could also just be hype.
Okay, first of all, before I answer that question, I want to express appreciation to you, Mike, and to the listeners here. I hope the listeners have had a chance to send their comments and questions in. Um, but I'm really grateful for the time and for the opportunity to have these kinds of discussions in this kind of depth. As you can see, even an hour is not enough. Okay, to answer your question, all of these things come down to our own responsibility for how we handle the technology. The technology is just a technology. The innovators will innovate. It's up to us to use the technologies responsibly. Now, based on what I've seen about how we handled social media, I'm really concerned because the social media should have allowed us, and that the volume of information available to all of us, I would have thought we would have seen as a benefit, where we would have sorted through the information and sorted out what was fact and what was not fact. But instead, as we've seen with social media, it's just become a disaster zone where it's almost impossible to find out what the true facts are.
I love the way you're talking about this. Keep going, because this is the way you're expressing is exactly where my concern comes from.
Thank you so much. So, and I appreciate that, Mike. So, if you look at ChatGPT, okay, ChatGPT could be terrific because it could obviate a lot of block and tackle work for a lot of people, but the people have to use it responsibly. In other words, before you just cut and paste from ChatGPT, read it to see whether it makes sense and it's based on fact. If you put my name into ChatGPT, if you ask ChatGPT, who is Daniel Arbess and what are his priorities, you will get, and I got to tell you, the good news is the bias of ChatGPT, as far as I can tell, is to the positive, but you will get all kinds of things about me that are actually to the upside not true. And so I could propagate that, and then everybody will think that I'm a co-founder of Stripe or whatever it is that ChatGPT is describing today. Or I could be responsible and say, okay, wait a minute, this is right, that's wrong. Before I pass that on to Mike and his listeners, I got to edit it. And I have to say that I'm a little worried that people are so distracted with the massive flood of information that we all see every day that they're more likely to just pass it along without doing the work to edit it. And that's the problem. It's completely counterintuitive to me that a world in which there is so much raw knowledge available to everybody, democratization of information, that we have all managed to get ourselves distracted, so we only look a millimeter deep when we need to be looking at the information in great depth to get the benefit of it and sort out the fact from the noise.
Which is basically another way of saying the line I keep using, which is amateurs look to the right of the equal sign, pros look to the left. Everyone's becoming an amateur because they're just getting the conclusion. I put out that tweet. I just found it. I shared it in the nest. Said it in a colorful way in late December. Artificial intelligence is going to make people dumb as shit. If you no longer require humans to think, it's the end of humanity.
Well, but that's the thing. Who can require humans to think? Only the humans themselves. And one of the problems that I have in this country and in general is that people are not taking responsibility for their own thinking and their own conduct. Everybody thinks somehow, or seems to think somehow, that they're entitled to somebody else doing or telling them what to do for them. And at the end of the day, we live in a great country because we're given tremendous latitude to take responsibility, but we don't have entitlements here. We have responsibilities as people who participate in a democracy and in a market economy. That's what these things mean.
I think that's a good place to wrap this space up. Again, everybody, please make sure you follow Dan Arbess. I am going to again have this as an edited podcast, probably in a couple of days here. I always love listening to Dan. You're a wealth of knowledge. The way you communicate and everything is just really. Thank you. Just from me to you. I always find a lot of nuggets of real wisdom there. So thank you everybody for joining. This will be my final space of the day, believe it or not, given that I think I'm at number 3.
You're very kind. Have a great weekend, everybody, and thank you for taking the time to listen.
Thank you, everybody. Cheers. Thank you, Dan.